Welcome back to Alpha Recap. Today, we're walking through a jam-packed post-close session. Markets closed for Juneteenth, and we saw a really interesting split between a concentrated rally in chips and AI names and a defensive rotation into healthcare. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks, Archer. Good to be here. Yep, a holiday session, but it was anything but quiet. Two very different stories unfolded in the same day.
Let's start with the headline mover. Marvell Technology Group jumped, and it wasn't small. Tell us what you saw there.
Right, so Marvell popped about 7% and finished the day around $310. What made it notable wasn't just the price move, it was the turnover. Roughly 235 million shares changed hands. That level of volume on an up day usually points to institutional participation, not just a retail spike.
Yeah, that tracks. So heavier hands were driving that move.
Exactly, and that fits a broader pattern we saw. Chips and AI names concentrated a lot of the upside, while other parts of the market were more defensive.
Which brings us to the defensive side. There was reporting about flows into Johnson & Johnson. What does that tell you?
It signals that some big allocators were rotating away from higher beta technology into dividend-bearing healthcare. In plain terms, when risk sentiment tightened a bit, managers leaned into steadier, income-generating names. So you had momentum in chips at the same time as a classic risk-off hedge in healthcare.
So, what really stands out here is that the market wasn't moving uniformly.
Yeah, absolutely. It was narrow leadership, a few names doing a lot of the heavy lifting, and a broader caution elsewhere. That kind of breadth picture matters for both traders and allocators.
Futures were also modestly lower as the holiday began, right?
They were. So you had this mix, concentrated momentum in some pockets, but a slightly cautious tone overall as people stepped out for the holiday.
Let's shift to earnings and dispersion. There were some big post-earnings divergences. Intuit was one that stood out.
Intuit was down about 13% in the 30 days since its report. That's a meaningful pullback and suggests analysts and traders were reassessing growth or margins. On the flip side, retailers like TJX, VF Corporation, Urban Outfitters, and immunology names like Immunovant posted modest post-report pops, some in the 3 to 7% range. So earnings were really separating winners and losers at the single stock level.
Right, earnings remained the hinge point for a lot of names.
Exactly. Even with these flow-driven dynamics, rebalancing, passive flows, earnings still drove stock-level outcomes. So you had macro and mechanical forces pushing around, but fundamentals were still the key differentiator for individual companies.
We should talk about index rebalancing. That was flagged as a material flow driver this week.
Rebalancing is mechanical. Index providers change weights, and passive funds must follow. That can create temporary buying or selling pressure, especially in mid-cap and small-cap names where liquidity is thinner. Portfolio managers were clearly thinking about the next reweighting window heading into the coming week.
Which means some moves are more about index mechanics than new company fundamentals.
Right, those moves can stick if technical support zones hold and if there's follow-through, but they can also reverse once the mechanical flows subside.
Let's pause for a brief reality check on the small cap side. There were some extreme examples.
Yeah, two stark cases. One name plunged about 64% to roughly 16 cents, and that trade happened on nearly 120 million shares. That kind of collapse usually points to liquidity squeezes, corporate news, or, quote, irregularities. It's a reminder of execution and idiosyncratic risk in low-priced stocks. Meanwhile, other small caps, like GigaCloud Technology, were getting retail attention around their 52-week highs, which can amplify volatility.
Not a great day for thinly traded names.
No, and it underscores the need for strict risk controls if you're in that universe.
We also had some cross-border legal headlines. Xiaoyi was in the mix.
Correct. Xiaoyi announced it would appeal patent ruling matters to the Supreme People's Court, and that injects legal uncertainty. For companies that use variable interest entity structures, that's VIE, adverse rulings can affect governance and the way revenues are recognized. It's a reminder that legal and geopolitical tail risks can play out over multiple quarters.
Okay, let's hit implications. How did this mix look for different investor types?
Traders and momentum players were watching liquidity and volume. The Marvell move presented a tradable momentum setup, and some were eyeing Nvidia near technical buy zones. But rebalancing makes for whipsaws, so intraday volatility was elevated. Long-term investors were reminded to look through rebalancing noise and focus on durable fundamentals, demand trends, margins, structural growth. Income and conservative investors likely nodded at the rotation into Johnson & Johnson, defensive, dividend-oriented exposure, while speculative small-cap traders saw heightened risk and the need for tight stops.
Short reactions, quick takes. Ready?
Yeah, go ahead.
Narrow leadership. Big deal.
Absolutely.
Rebalancing can distort price action.
Right. Temporary and mechanical.
Small caps, caution.
Yep, tight risk controls.
Let's go through a few strategic considerations heading into next week.
Sure. First, monitor rebalancing windows and ETF flows because they can create temporary dislocations. Second, use volume as confirmation. Heavy volume on moves signals institutional commitment. Low volume gaps are more suspect. Third, separate earnings noise from structural change. Follow analyst revisions and management guidance after earnings. Fourth, factor legal and geopolitical tail risks, especially for China-related firms using VIE structures. And finally, be selective on sector exposure. Decide if chips and AI are a momentum play or if a defensive tilt into healthcare makes more sense for your time frame.
Solid checklist. And a couple of practical points. Analysts broadly agreed that rebalancing was a near-term flow driver, and heavy volume moves mattered for momentum. But they diverged on whether the rotation into healthcare was durable or tactical.
Exactly. Some think large allocators are making a longer-term defensive allocation, while others see it as a short-lived hedge. Time and evidence, follow-through flows, and sector earnings will tell the story.
Before we wrap, any last surprises from today?
Honestly, I was a bit surprised by the sheer volume on Marvell's move. It was convincing. Also, the degree of Intuit's post-earnings pullback stood out. That kind of decline in a month signals meaningful reassessment. Market drama, holiday edition.
All right, let's close with clear takeaways.
Number 1, leadership was narrow. Chips and AI concentrated gains, while the rest of the market leaned defensive. Number 2, index rebalancing and passive flows remain important short-term drivers. Expect transitory distortions. Number 3, earnings continued to be the main determinant of single stock performance. Some big winners and losers emerged post-report. Number 4, small cap moves can be extreme. Trade execution and liquidity matter. And number 5, legal and geopolitical risks can change multi-quarter expectations for certain cross-border names.
Good summary. Quick reminder. This discussion was informational only. We didn't recommend buying, selling, or holding any specific stocks, and we're not providing personalized investment advice. Analysts note a range of possible outcomes.
Yep, always check with a licensed professional for personal guidance. This is market color and analysis, not a prescription.
Thanks, Matt. That's it for today's Alpha Recap. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Goodbye.